Hello and welcome. Normally at this time, we will have an open metaverse show. We talk about NFTs, we talk about communities and friends and everything else. But today, we're going to be talking about the specifics of what happened this week. We're talking about Celsius, 3 Arrows Capital. And I'm very excited to welcome to the show Bobby Ong, founder of CoinGecko, and C Squared from Index Coop, who has a very specific and interesting take on state ETH and a whole bunch of other topics that we're going to get into. Bobby and C Squared, thank you so much for joining us. It has been something of a week. Bobby, how have you seen all of this?
And it's one of those crypto bear cycles where prices crash. I mean, I've been in this space for close to 10 years now. 2013 was when I got into crypto, so 9 years. It's bull and bear market comes by all the time, and price goes up very fast. Price comes down equally fast as well. I mean, it's always painful seeing all these things, but it is what it is. Crypto is a very volatile industry. We start seeing which are the guys who are swimming naked in the sea, and all these guys who are over leveraged get wiped out, get liquidated, basically.
C Squared, you have a very specific viewpoint on this because Index Coop is all on chain, it's all visible. I'm curious how you saw what happened this week and what your perspective on it is from where you sit.
Yeah, I think that there's obviously massive advantages to operating in an on-chain environment because there's this kind of fundamental level of accountability and visibility that is just enforced from the start. So, a lot of the CeFi services and other organizations that operate off-chain don't necessarily have that same degree of transparency all the time into what they're doing. They don't have to back up all the different decisions they're making. They don't have to point people to risk automation they have in place. They don't have to necessarily own or not own, but that they aren't accountable to quite as many actors because there isn't as much transparency in the way that they operate. So, the state ETH fiasco this past week is definitely an example of that. I think that there's also many more dominoes to fall. I think a lot of big ones have begun to fall, but there's probably more unexpected outcomes from some of the liquidations and some of the potential insolvencies that we've heard about over the past 7 days.
This boils down to data at the end of the day. It's like, what do we know? What do we not know? And what do we take on faith? Because with Celsius, they presented themselves as a very trustworthy, transparent organization. And really, like the kind of connective tissue between fully decentralized and central. I mean, I'm not even sure how to read it anymore because I know a lot of people shield Celsius as a place where actually you could feel safe. But Bobby, how did you read Celsius? Were you ever worried about them? Were there any concerns about them?
I mean, I'm always one of those OG guys. I mean, if not your keys, not your coins. So, I mean, if you put money in any centralized party, you're basically trusting the creditworthiness of that party. So when you put money into Celsius, you're basically betting that Celsius won't go bust. It's the same for putting money in any exchange. If you put money in Binance, in Coinbase, and so on, basically betting that it won't go bust. I mean, many different things could go on. Like, I mean, they could get liquidated, for example. They could lose the private keys, for example. We've all seen kind of the horror story of Mt. Gox in its early days that went bankrupt. In fact, all the creditors, people who had Bitcoin back in 2013, 2014, still have not get back their Bitcoin after so many years. They're still waiting for the bankruptcy proceedings to complete and get their Bitcoin back. But yeah, I mean, basically, Celsius, I guess, is one of those guys that kind of took money from retail investors promising very high yields. I mean, I took a look at the website. They're offering up to 7.1%, 7.2% on their stablecoins. I have no idea how that is even possible in this current market condition. This has not been sustainable for quite some time. I mean, we've seen the big unwind from Terra and UST promising 20%. There was obviously a Ponzi, and the Terra Foundation had to top up the reserves in Anchor once, and then when it happened second time, like, it was a very clear signal that this is going to end. And I mean, I guess the hard thing was how a $60 billion currency just went to zero overnight. That was quite a crazy thing. I mean, It's kind of the size of Lehman Brothers, I think, 60 billion to zero. I mean, we've seen price crash like 80, 90%, but like going to zero in just 1 week, that was a horror story. I think the worst was those who kind of stake Luna, and it takes 21 days to unstake that Luna. So seeing the value, I mean, you can't even do anything about it. It takes 21 days. You're just watching a horror show right in front of your eyes. You can't even sell it. There's nothing you can do. And I mean, the Terra situation kind of, I mean, it's causing some dominoes to fall. And this is, I mean, Celsius took a loss. I mean, they didn't disclose how much they lost. They announced that they managed to sell their UST position. I don't know if they have any Luna, but what percentage of haircut did they take? Nobody knew. So obviously Celsius is part of the collateral damage from Terra. Three Arrows Capital was a bigger collateral damage. I guess Suzu was talking about the super cycle, and I guess he was putting money where his mouth is, and then backing Luna. And then I think there was a lot of rumors about Three Arrows putting a $500 million OTC deal to buy Lock Luna during the cascading.
I don't think it was a rumor. I don't think it was a rumor. I think it was true. I think they absolutely did. I think they absolutely did, because they never denied it. If it isn't true, you deny it, and you deny it publicly. Yeah. They never did. They absolutely they bought the garbage, and it went from serious money
to $600.
$600, yeah, less than an ETH, less than an ETH. I mean, that's a serious fuck up. So C Squared, I mean, you run Index Coop. That's your baby. Staked ETH clearly has played a part in all of that. How do you read all of this? Like, staked ETH isn't a bad product. It is not an inherently bad thing, and yet it's being tarred with this brush. We're talking about depeggings. I'm curious for your take on that.
Yeah, I think that, to your point, it is a great product. It is a much better solution if you're looking to get exposure to the staking rewards without having to forfeit access to your ETH for whenever the merge is completed, and then the upgrade after the fact will actually allow redemptions. So I think that there's definitely a lot of fun, a lot of misinformation out there about what is actually going on with staked ETH. But one of the beautiful things about staked ETH is that it is an on-chain product, and so all of the markets that exist for it, all the activity related to staked ETH, can be found if you're willing to dig into the on-chain information. And so a lot of people have been looking at the curve pool that has the staked ETH, the vast majority of liquidity on chain, and that's gone from that's gone from $3 billion plus when we launched a staked ETH leveraged liquid staking product to, I think right now it's about a little bit more than half $500 million. So if we can kind of dig a little bit deeper, though, most of the activity, most of the depeg or the discount, I think discount might be the best term to use in this case, is just attributed to people being too highly levered and then overexposed to liquidation whenever people needed to start selling staked ETH to either cover their debt or cover other debts that might not necessarily be related to that staked ETH leveraged liquid staking strategy. So I think the piece of the puzzle that isn't quite as intuitive is that there's an accelerating effect to that discount. So for example, if the exchange rate is 1 staked ETH to 1 ETH, that's when most people opened up these massive positions. I mean, hundreds of millions of dollars worth of leverage. And what they didn't account for was a discount event. So whenever that staked ETH collateral goes from being 1-to-1 to maybe 3, 4, 5% of a discount, there is a very real effect. There's a depreciation of the collateral that's posted. And so you then have to start selling collateral to pay your debt. And that just puts a ton of downward sell pressure on the price of staked ETH, even though there's hundreds of millions of dollars worth of liquidity on the market still. So it's definitely a tricky problem to sort through. But I think that the more people that moved into this leveraged liquid staking strategy without proper risk automation in place, they almost made the problem worse, because as soon as one person starts selling, then other people have to start selling. And there's a cascading effect. There's kind of a contagion effect almost to anybody that's operating the strategy on chain. And that that includes InstantApp, that includes Three Arrows, that includes Celsius. One of the ways that a lot of these centralized services were able to advertise and achieve these really high APYs for their customers was because they're using leverage across the board, for stable coins, for ETH, for any other blue chips that they support. So that is definitely the kind of the tricky piece of it, is getting into the nitty gritty data and figuring out what's actually going on. There's definitely been a lot of people leaving that trade and closing out positions because of the state ETH discount. So it has had a kind of a leaning effect on who's operating the strategy and in the market.
So we have a comment from TJ Spoonman Jack, who says every crypto went to the Ponzi schemes are exposed. UST and Anchor, it was a Ponzi. It was a Ponzi at scale, but it had massive support and it has a massive reserve. But that reserve just got obliterated by Abracadabra and all these other different kind of weird degenerate, strategies that were in place. State ETH is not that, I would argue. State ETH is built on some fairly sophisticated and fairly robust economics. State ETH is not the problem here, and it's not a Ponzi. What's a problem here is greed, plain and simple greed, that somewhere somebody made the decision, hey, we're going to do this, and we're just going to take a little bit more, and then we're going to add a little bit more, because State ETH is offering this, we've got vanilla ETH and whatever rewards we can put on top of that. And then we can get these additional rewards, and then we can put it into Curve, and then we can offer even higher returns. So is there a degree to which the lending platforms are to blame, not for offering a product, but for being in competition with each other to offer a better product? It feels like this kind of race to the bottom to offer the best yield and everything else in a highly competitive market. But I'm curious what you think of all of that.
So I think that there's always a balance, and again, because we operate an on-chain product, ICE, that executes this leveraged liquid staking strategy with State ETH. So one of the reasons we're so close to it and constantly watching the on-chain data is because we have a dog in the fight, so to speak. So I think that we made some conscious design decisions, though, to not only forfeit a little bit of incremental yield for a little bit more safety for our customers, for our token holders. But we also have risk automation in place that could account for and adapt all the leverage to massive discount events like the ones we've seen over the last couple of months. And I think that there is definitely opportunity for competition. Again, there's probably 2 or 3 other products, services, or funds that are trying to execute the same strategy, but they don't have as much risk automation in place to try and adapt and cover themselves whenever some of these discount events occur. So I would say that there's almost this obligation for anyone that's offering, especially a retail-focused product, to really be buttoned up on the risk management side of things and account for situations like these. And I can't say that everyone has done that, and I know that that's something we're constantly trying to do even better than we have done. But it definitely becomes a very serious conversation to have. And I think other teams have to ask themselves the same sort of questions. Are we operating the best interest of our customers? Are we communicating risks? And are we adapting whatever we're offering so that we can prevent any sort of liquidations and preserve customer funds?
But that should be really obvious, right? Well, you're talking about risk automation, and I'd like to dig into what that actually means. But I mean, from a really basic perspective, this shit's obvious, right? You don't overlever, particularly when you understand crypto. Bobby, you've been through bear cycles. You know how rapidly the floor can just disappear from under your feet.
Yeah.
This is Alex Mashinsky. He's not a noob by any stretch, not at all. And nor Suzu. These guys know their shit. So what happened here?
Yeah. I mean, I guess that's where I'm surprised as well. I mean, someone as smart as Suzu, when over leveraged and I mean couldn't unwind his position in time. I mean Celsius probably have a different story as well. I mean, he took users funds and went YOLO on all this DeFi protocol. I mean, there's a lot of before even this liquidation. I mean, there's a lot of rumors about Celsius losing $70 billion in stake count. And then also, I mean, it's another liquid ETH staking protocol, and then $50 million in Badger DAO. So that's like $120 million worth of losses there. How are you going to plug that hole? I mean, nobody knew how they were not really transparent on how much their balance sheet is. So I don't know how they covered that thing, but then they went crazy. I mean, but coming back to your point earlier as well on Terra, I mean, Terra and STE, they are quite different. I mean, UST and STE, they were different products in the sense. UST, I mean, Terra was trying to kind of say that it was backed by reserves. They have about $3.5 billion worth of Bitcoin back in USD, which sounds a lot of money actually. But in comparison, UST at its peak had over close to $18 billion worth of circulating supply in market cap, right? So it's roughly about only 20% of backing. So it's like backed by Luna, which everything went down, and then the backing went at one point. UST was backed less than the underlying assets, so it was kind of insolvent in a sense. STETH, the issue with STETH is more of a maturity mismatch, and I guess I mean it's 1-to-1 to ETH, but is the timeline is not now. I mean, you only get one ETH when the merge to ETH 2.0 happens, and who knows when the merge will take place. I mean, the developers say it's coming in August now, but I mean, that's been delayed so many times. I mean, the past couple of years. I mean, crypto. I mean, developers.
You don't bet on it. Not to that degree. You don't bet on it because like the merge is not really a tradable event anyway, and like it's a It's a 12-month delay for actually getting your ETH out, and that's designed specifically to make it solid, make it stable. But like, oh my god, so I think for people at home, they might be confused as to why there is a discount, why this so-called depeg has happened. Bobby, do you feel happy taking that on and explaining why that has happened?
Yeah, I'm happy to try explain it. So I mean, I guess, well, I mean, ETH and STETH it's not a peg. It should not have been called a peg. It should not be 1-to-1 in the first place. But I guess because it's traded on Curve, which is known as the stable swap or stable exchange, where, I mean, you kind of assume they should be traded within a very small band of price band. People kind of take that it should be traded the same. I mean, there could be many reasons why STETH should be traded at a discount to ETH. I mean, the first very obvious one is liquidity, right? You may not, you don't get the ETH until the merge happens. So who knows when the merge will happen, and then that obviously should represent a discount. But there could be tons of other factors, like Lido could have a smart contract bug, and suddenly all the ETH that is locked in STETH can't be accessed anymore, which was pretty much what happened with StakeHound. So anyone who has StakeHound liquid tokens, basically those go to zero, for example. I mean, obviously that hasn't happened with Lido, but that could theoretically happen. And if that happens, then it just goes to zero instead of 0.9. I think Suzu kind of, I mean, he claimed, I mean, ETH and STETH should be pari passu, means it should be traded nearly on equal footing, which means 1-to-1. But I guess the market, is showing him that it's not really the case.
Yeah, that pretty much sums it up. There's a certain amount of risk attached to it, but it's not like the two were ever meant to be bonded to each other. It's just an assumed thing. Like if you can redeem this token for an ETH at a future date at some point, then it should line up with ETH. But actually, the sunk cost or the opportunity cost is baked into that, and therefore you get a discount. It's a weird thing, but markets do what markets are supposed to do, and they decide the price. And you are a participant in that mechanism, whether you like it or not. And I think that's the thing that catches people out. The market owes you nothing. The market absolutely 100% owes you zero, and you are simply there as a passenger, and it's up to you to decide how you read that market. But Bobby, you've been through this since 2013. You are properly OG. So what message would you have for people who are suffering through their first bear market?
I mean, it's always tough going through a bear market. I mean, when I first went through my bear market in 2013, I mean, I had Bitcoin when it was $1,000. I mean, I remember buying Bitcoin. It was $1,200, and then going it down, writing it down all the way to $200, feeling like a complete idiot. I mean, the one advice I could say is just kind of take a long-term view of the market for any holdings that you have. I mean, hold the blue chips, and in this case, it's Bitcoin and ETH. And then take a multi-year view to this because the crypto bull and bear cycle typically revolves around a 4-year cycle, which at this point in time typically revolves around Bitcoin halving cycle. So eventually the market will recover, and then it will go parabolic up again. But I mean, if you didn't manage to sell at a peak previously, you can just hold on to it or just dollar cost average more money in if you have sufficient cash. But I mean, everyone's different, right? It's very hard to say. If you're over leveraged, then you try to salvage a position right now. If you have cash, I mean, some people are kind of like putting in bid orders to kind of buy some of the chip. Obviously, it's very hard. This time, the macro environment is vastly different. Like, I mean, inflation is raging in the US. Interest rates going to go up. We just came out of 10 years of quantitative easing. We are now going through quantitative tightening. Interest rates going to go up. Things going to get tougher. Equity markets getting completely wrecked as well. So yeah, I mean, just take a long-term view. I mean, the basic idea is if you cannot sleep well at night, this means you are probably over leveraged and you should probably not have that large of exposure. Typically speaking, if you are a newbie, you might want to choose anywhere between 1 to 10% of your net wealth and kind of put into crypto if you don't have any exposure. If you have all your exposure into crypto, that's also very risky. So, but yeah, general rule of thumb, if you can't sleep well at night, you're too exposed in the market.
Yeah, we've seen this. I mean, I've been so many times. China FUD, Mount Gox, Quadriga. I mean, so many times. C Squared, what's your experience of this market being like? Have you been in it since the old times, or are you a relative newcomer to all of this?
Yeah, so I actually started digging in about 2014. So I've been through a few of the bull bear cycles now. It's always uncomfortable, right? You never really get fully used to it, but you do kind of have some battle scars and some tactics for getting through and continue to build and paying attention to what is most important and kind of the future that we're trying to construct, the infrastructure we're doing it on. So I think that it's definitely a challenge because there's a fantastic book out there, The Psychology of Money, and it does a great job of iterating or reiterating how tailored each individual's opinion, perception, objectives are when it comes to money, investing, finances, all that. So it is really hard to give advice that is actually applicable to the vast majority of people. But I do think that the longer you're in the space, the more you see instances like what we're in right now as really good opportunities to scoop up blue chips, or maybe it's DeFi 1.0 tokens or something like that. So it is challenging though, because the macro environment that we're in, as great as it would be for crypto to just operate in a vacuum, it's typically a proxy for the way people see risk on assets. And then there's obviously a ripple effect there in equities and bonds and fixed and everything else that people consider as an alternative for their money. So I think that's the other thing that kind of helps build context and give a little bit of reassurance, is that the longer you've been in the space, the more you've kind of experienced and survived some of these bear markets. But you also begin asking questions and learning about some of the broader factors and implications of the Fed raising interest rates, or equities falling off a cliff, because there's absolutely an interrelation here, because there's a lot of money out there. It can go a lot of different places. So the opportunity cost is not isolated to crypto alone.
I remember. Sorry, I was just going to say. I remember in 2018 thinking that I needed to walk towards contrarian views. So I started reading Nouri Rubini, and I started listening to people who were saying the equity market is completely overinflated. You should be raising cash right now. You should be raising cash because at some point this is going to implode. That was 2018, and you go, it looks fine. It looks fine. And then 2021 happens, and you go, it's fine. And then you realize, well, this was very wise. That kind of long-term planning only makes sense once you've really had your ass ripped out, like properly destroyed. And then you go, I think cycle one that you go through, it's tuition. It's your university education. Cycle two, you test your ideas. Cycle three, you clean up. At least that's how I hope it should be. Like, so Bobby, this is cycle number 3 for you. Did you clean up?
Yeah, I hope so. I think I come out, took some profit along the way, but yeah, I mean, so it's still surprising. I guess what surprised me was how high the market went in this cycle, and then I guess
really, because what was weird for me was like 2017, literally anything would pump beyond its all-time high. And you would go on Bittrex and there would just be stuff which had no fundamentals whatsoever. And it was Cryptopia, CoinGecko. I mean, like everything pumped. And then this cycle, the shitcoins suffered. Like there used to be XVG, for instance. XVG was a token that should have pumped massively this cycle, and it didn't. And I think that's because of NFTs. I think NFTs stole the thunder of the lower level shitcoins. And so we have this weird position where people own JPEGs, and intrinsically they own IP, and they have a different thing going on. And it's so strange because actually that IP, if you are smart about it, has some value for you. It's a very different market that we've been sort of dropped into this time around. What are your thoughts on that?
I just want to say it. I mean, XVG is one of those things where, every cycle, like the winners of the cycles are usually different from the winners of the previous cycles. People kind of like, I guess people think of tokens as kind of like fashion. Like people don't want to wear last season's fashion like during this cycle. So XVG is probably one of those that was kind of hot in the previous cycle, and people kind of latch onto a new narrative. DeFi was the narrative in 2021, and then NFT was the hot new thing in 2021 as well. 2020 was DeFi, 2021 was NFT. Everybody went crazy collecting these NFTs. I guess we should see, right, how bad the NFT market. I mean, in USD terms, like all these NFTs are completely wrecked. But in ETH terms, I guess just still holding on, I suppose, in terms of ETH. So how bad it will be, nobody knows yet. But as you said, that's inherent. I mean, you buy it for the, I don't know if you like the photo, and you own the IP of that image. So that's probably some use case, I suppose.
Oh man, it's so interesting because I have this photographic memory of all the ICOs in 2017. So many of them, and so many of them now, 4 years later, you're looking at them and like, what did you build? I remember the Polkadot ICO. I remember the Bancor ICO. I remember the Tezos ICO. Do you remember the EOS ICO? The year-long EOS ICO. I mean, 4 billion they raised over the course of a year, and like, where did it go? Where did it go? That's absolutely insane. Like, you imagine Solana announcing they were going to do a year-long like fundraise, and they were going to raise 4.5 billion. They raised 400 and something million earlier in 2021, which means I think they're pretty good for the rest of for the rest of the bear market. But 4.5 billion and EOS. I mean, what the fuck? C Squared, do you have that kind of picture in your head of the craziness of ICOs and what happened there and who survived and all of that?
I do. I remember specifically there was one project. It was Moat, mother of all tokens. That was the idea, and it was essentially an index. That's really what it was. It was an index of all of the top tokens out there. That's one that's burned in my memory. I'm kind of thankful actually for some of the accredited investor protections I think that were in place at the time, because I probably would have thrown a little bit of cash that way just for fun. But it's very similar to the ICO craze in like 2017 and some of the NFT stuff we've seen over the last year. There's a lot of kind of rhyming that's going on between those two phases and those two capabilities. But I think that at the end of the day, even though most of them go to zero and don't actually deliver on any projects or ship any code, there is like a fundamental unlock that's occurring because of the ultimate utility that it's proven out. There's not too many of those 2017 ICOs that have survived, but those that have proven that it's actually a viable way to raise capital and bootstrap a project. And on the NFT side too, there's a lot of like NFTs that are coming out today. I've been a spectator for a long time. Didn't jump in until about 6 months ago because some of the utility NFTs that were coming out on the market. But I think that it proves like a fundamental concept, and it's a use case that we can actually put some weight behind in the ICO case, and then also in the NFT case as well. So it's always funny to see the same sort of cycles repeat themselves, but with kind of different use cases. But I do think though that there's going to be a lot of stories that we tell in 3 to 5 years about some NFT project that we thought was going to be the end all be all that is constantly worth 0 cents on the dollar. So I think NFTs are a little bit more fun than ICOs because it's not necessarily about making more money on your money. I think it's a little more harmless as well, but a lot of similarities to both of those kind of boom and busts.
Well, I mean, it's not financial advice, but I as someone that does creative things for a living, I get a huge amount more enjoyment out of owning an NFT than I ever did out of a shitcoin. Interestingly, 2017, because I keep making these comparisons because I just went through this cycle and felt it deeply in my gut. But we had pantomime villains. We had Jihan Wu back then. We had Bitmain. We had Roger Ver. We had Eric Voorhees. We had Charlie Shrem. We had this kind of OG vanguard of Bitcoin fanatics. Craig Wright as well. I mean, you cannot forget about Craig Wright. And weirdly, this time we got a different cast of characters. Alex Mashinsky was really in the background. Do Kwon very much in the foreground. But, you know, the survivors of this, and I'm talking about CZ and Justin Sun. Like, Justin Sun should be in jail, right? Like, how is he not in jail? It's unbelievable how this guy continues to act as if like he's untouchable. He's most excellent plenipotentiary of Grenada. I find him absolutely fascinating. Bobby, do you have a take on Justin? You must do.
I mean, I went to Consensus in New York. I can't remember, 2018 or 2017. I think 2017 maybe. And then like Justin Sun like sponsored the lift lobby, and then like the doors it just opened up, and there was his face just right in front of the door. That was like, okay. I mean, you gotta give credit to the guy. I mean, he's not very classy in the way he does marketing, but damn man, he's a survivor, and he's probably one of those billionaires that is waiting to be humbled by the market, especially what he's doing with USDD now. I mean, we've seen UST, and he's taking the exact same model, replicating it onto TRX. And I mean, obviously TRX pumped for a bit, but like, obviously we've seen this is not sustainable. It's going to crash and burn. I mean, but he's got a few $1 billion waiting to backstop things, and I guess he's just waiting to laugh and say, "You see, I told you it's safe." But I don't know. Maybe he gets hunted one day, and is left to be humbled by the market. But he's one of those guys that is so brash, arrogant, but I guess build a name for himself. Let's see how he goes.
Well, another one that's really interesting is Richard Hart. You know, like Pulse Coin, Pulse Chain, the greatest airdrop in history. Like he bought the largest diamond and renamed it to the Hex diamond. I mean, like in some ways, I hate all this stuff. In the other ways, it's like we wouldn't come back to this space if we didn't have these larger than life characters. We didn't have this daily soap opera. C Squared, what brings you back every day to keep building? Because like it's not easy doing what you do.
Yeah, I definitely think that bear markets have kind of a cleansing effect. And so a lot of the noise dies down. A lot of these like wild, outrageous projects and personalities tend to find other things to focus on. And so that makes it a little bit easier, I think, to just kind of keep your head down and build. I mean, at the end of the day, you know, I'm one contributor of many contributors at the Index Co-op, and we're all kind of like united by this opportunity to build, you know, decentralized financial products, like truly decentralized on-chain financial products that are transparent, that deliver as much value as possible to token holders. And I think that that's really what gets us back. I know that sounds a little bit corny, but like that's actually what's exciting to us, is not just how do we make an index for DeFi or the metaverse, but how do we actually create financial primitives that have never existed? How do we actually, you know, collate, capture, extract value from all these new protocols, all these new capabilities, and do it in a sustainable and secure way, so that people can, you know, actually own their own keys, be comfortable holding products that capture yield or give exposure and manage leverage for them. And those are the different kind of paths that our team is constantly on. And what we're definitely headed in a really exciting direction. And in terms of what we're able to build, I mean, money Legos, it's just the coolest concept. It really is exciting to think about what all can be constructed in such a rapid way that hasn't been able to be built before. So that's what keeps us going. You know, we definitely have a big pipeline with a lot of products that we're excited to get out to the market, because there's a lot of good in DeFi. There's some fundamental capabilities that just simply don't exist in traditional finance that lead to better outcomes for everybody involved. And those are the opportunities we want to capture. That's what we want to tokenize, are those really crazy innovations that can actually lead to the best possible outcome for users.
Bobby, CoinGecko was an alternative to CoinMarketCap. Why did you feel it was necessary to even build CoinGecko in the first place? Where was CMC failing for you?
So we started CoinGecko in 2014, April 2014 to be specific. And our original vision was to kind of capture alternative data points. And so we started tracking community stats, developer stats on CoinGecko, seeing basically how many GitHub issues, pull requests, how many stars on the repo, how many people following this coin on Twitter, on Facebook, on Reddit, and so on. I guess over time things change. If you launch an ERC20 token, you don't really necessarily have to make any developments on the token on the smart contract level itself to kind of change things. And then those metrics became harder to track. So we were, for a long time, we were trying to kind of push an idea that, you know, you shouldn't be looking at token purely on just market cap alone. But I guess the market is very influenced by how the Web2 market is a TradFi market, and everybody's kind of thinking about market cap. Okay, so we kind of changed the way we organize information on CoinGecko, but we always knew at the back of our head, you know, crypto is kind of a new sector. There will be new ways of evaluating tokens. Some of them can be inspired from the TradFi market, but some of the metrics will be completely different, and how we look at things will need to be different. So, and we started seeing these things as well. We started looking at things like people started thinking about fully diluted valuation. I mean, to some extent similar to TradFi market, FDV, but in crypto there are additional metrics like TVL, total value locked. These are not available in TradFi market, and then you start making ratios similar in PE/PS ratio in the market, and I start thinking about other things as well. So I think crypto is interesting. Where we are right now is probably just scratching the surface of what sort of metric or ways of evaluating the market, and I think we are just at the early stage. And I think from CoinGecko's point of view, we think that crypto's tokens, anything that can be tokenized will be tokenized in the world, and there will be a future where there will be millions of tokens. And how do we navigate this future where there's millions of tokens? It's going to be a really confusing future. And we at CoinGecko, we just want to build a foundation, the infrastructure layer for everyone who want to make sense, who want to track these tokens. And there will be tokens representing anything, your event ticket, your time, your textbook, I don't know, everything. I mean, we've seen NFTs as well. So how can we track this thing? And CoinGecko wants to be that place. So we want to be that place. We want to be the right place. And crypto's constantly changing. So we're always attuned to the market demands and try to make improvements to kind of fit these things.
What did you think when Binance bought CoinMarketCap?
I was pretty surprised actually that Binance bought CoinMarketCap. Also, the rumored price was pretty high as well. So that turned out to be a very good thing for us. First, it set a comparable for how much CoinGecko should be valued. Nobody knew how much it should be valued before this. But the other thing was, I guess what surprised me as well was how everybody kind of valued independence. Nobody liked the fact that Binance was owned by, CoinMarketCap was owned by Binance, and Binance started messing around with the metric and the way they rank things, whereas we're not owned by anyone. TM and I are the only two founders on the cap table, and we don't take any investments from anyone. And so we're pretty independent. No exchanges have any influence or control how we display data. And I guess a lot of people appreciated that and kind of switched over to us after the acquisition. And I think we also did some stuff where we were first to start tracking the DeFi market. We started tracking Uniswap, and we could track all the long tail, the shit coins that were trading on Uniswap, and people appreciated that. I mean, obviously now we do have a listing criteria with too many shit coins these days. We don't really list everything. We started, I guess, clamping down, if you may. And then most of the smaller tokens, we started a new product called geckoterminal.com, which basically is an on-chain token tracker that tracks all the trades on all the DEXs. So we track over 35 different chains, and there's over, 200 exchanges, 200 DEXs, and close to, I think there's close to 200,000 or 500,000 tokens actually track. A lot of them are spam and scam tokens, but is this such a market, right? I mean, the decentralized market, anyone's free to create tokens, and you get wide variety of tokens. Obviously, most of them are pretty useless, but it is what it is.
It is what it is. I mean, yeah, it is. It's the game we play. But at the same time, I'm highlighting James Gaines' comment here, which is perhaps if you talk about something in multiple videos, highlight the high risk. It's something I grapple with every day. It's like, how how much do you want to be positive about opportunity and downplay the risk? Because yes, there is opportunity. And how much should you be the guy that says, no, this is garbage, this is garbage, this is garbage? Because most of it is, let's be honest. But at the same time, we're in a sandbox right now, experimenting, trying stuff out. And if you're okay with that, then you'll take on that risk and be okay with it. But I think for UC Squared, like, how much do you see the role of Index Scoop now in terms of education, in terms of helping people navigate this space, as much as building a great product?
Yeah, so I mean that's especially because we're offering these, index products and other products that are meant to capture value in some way for customers. It's incredibly important that we not only disclose risk but educate people on risk. Generally speaking, I mean it's not the most exciting topic, right? When you tell people to do their own research isn't always the most productive way to approach the problem. So a lot of our growth team and our content producers spend the majority of their time focusing on explanatory materials, right? Educational pieces, just getting people to kind of grasp not only like the core concepts of the products we offer, but also what it means for the rest of DeFi and the rest of the crypto ecosystem more broadly. It's again, it's not a fun topic to talk about, but I think one thing that we actually will all stand to benefit from as maybe like institutional actors enter the space. Maybe that's a little bit later on than we originally thought because of all the volatility the last few months. But they traditional money managers, institutions, all these other actors that are equipped and familiar with risk and how to quantify it and how to understand it are going to demand more information. Are going to demand a higher knowledge base. They're going to demand a lot more transparency into these things. And I think that's going to really kind of rise, rising tide lifts all ships in the sense that retail customers today may not have as high of standards of, I need risk disclosures to look like this. I need really good explanatory materials around the way that leverage works here or indexes work there. And I think retail and other consumers that are already on chain will benefit tremendously from that just heightened level of accountability and educational requirements. So it is tricky though, right? It's a delicate balance to strike because you want to promote things, you want to get people excited about it, but you also don't want to lead them down a path where something could happen that they're not, aware of or a risk that they're not exposed to. So it is a very important piece of the puzzle, though. It's something that we spend a lot of time and energy thinking about and addressing.
Yeah, James Gaines also has a comment that the Defiant heavily promoted Terra. We don't promote anything. We talk about stuff we find interesting. And I talked about Terra and Anchor specifically, must have been mid-January 2021. I saw Anchor and I saw it promoted itself as the benchmark fixed interest rate for DeFi. And at that time, I was really off-put by farming. I thought farming was garbage and I didn't want to promote that. But then I saw this thing was like, okay, well, there's a fixed interest rate. This is something that could appeal to normal human beings who have terrible interest rates from their banks. So I talked about it a lot. And I it's totally on me that I did this. And was I promoting it? I guess it looked like I was. And it's horrible to feel like people made purchasing decisions based on what we covered and how we covered it. But at the same time, like, should we not cover it? Should we not talk about it? What tone of voice should we take on it? And I think about this all the time. Like, what is the right balance to strike? And Bobby, you have a primarily a data platform. You present the data and you present it in a way that's digestible and people should make their own decisions. So I guess you're kind of impartial in that way. But you also have a brand, which is CoinGecko. That is what you stand for. So where do you stand on this? How do we educate things,
It's a tough one, right? I mean, crypto is one of those things that something that looks like a scam at the start will end up not being a scam at the end. Bitcoin's origin probably is one of those. It looks like a scam at the start, but it's not a scam. Some things does not look like a scam at the start, but eventually turns out to be a scam. So I guess you can argue Terra and all the other Ponzi's that have kind of collapsed. Terra's probably an example, a good example. It does not look like a scam at the start, but changes or some of the directions that have been the decisions that we made turn into a scam and then it kind of collapse. So all those hard things. I always like to tell people, don't trust anything that you read or anything that is analyzed by anyone online. Like you got to like do your own research. But it's easier said than done, right? Most people are lazy. They don't want to do the research and they just trust whatever influencers are saying. But you just can't trust the influencers. I mean, who knows whether they are paid or not paid? Who knows if they're shelling their bags or not they're shelling their bags? It's very tough. Yeah, I mean, it's a tough question. Like, I mean, I guess if I'm in your position, maybe one thing to do, I mean, and I tried, I guess from our side as well, I mean, probably should always disclose some of the risks, inherent risks, and smart contract risk is always there, I suppose. For any of these DeFi protocols, there's always a risk. Even Bitcoin, right, I guess. I mean, there's a non-trivial probability that it can go to zero in the next few years, next year. I don't know when, but there's a non-trivial probability it can go to zero. I mean, there are risks. Governments can ban it, which makes it extremely hard to kind of access it. I mean, if you're in China, that's Bitcoin's effectively banned. I mean, you can't just
there's a baked-in risk, which is it becomes so unprofitable to mine it that people stop mining it. And if you're solely relying on transaction fees to keep the network alive, and if no one is using Bitcoin, well, then it will die.
Yep.
And all it has is store of value, which is a pretty powerful idea. But if you're relying on Michael Saylor and to a lesser degree Nayib Bukele, who is just the most extraordinary character, to guide your purchasing decisions in terms of Bitcoin, then you have to allow the opposite version of yourself that has the contrarian view to at least have a dialogue with you. And I think that's the best thing that you can do. Just if someone doesn't agree with you and there's very vocal in that disagreement, go and look at what they're saying and give yourself at least a chance to listen to what they're saying. Otherwise, you are in a cult and you're in cult-like behavior and cult-like situations, and that is no good for anyone. You have to act against yourself and take the opposite position. And if you don't like what you see on the other side and you are happy with where you are, then great. But at least do that homework, you know? So C-squared, Supercycle, be honest. Did you get caught up in it? Did you buy it for even a fraction of a second? Were you just like, oh, that would be nice. Supercycle would be good.
So one of the short answer is yes. We have some opportunities every now and then for contributors to get paid in our products. So I definitely took advantage of that on a few different occasions. I got some IC ETH at one point for my monthly salary. I also got some. We have an NFT index, JPG. That launched not too long ago. That was my first venture into owning NFTs, albeit kind of indirectly. So definitely did some buying though. I paused ETH. That's probably the biggest percentage of my personal portfolio. I think I paused ETH purchasing whenever we breached 3,000. But I've started buying again for whatever that's worth. Staked ETH also. Big fan of the discount. So, people are comfortable and they trust Lido and those assumptions are reasonable to them. It's a pretty fantastic opportunity, especially if you take a long-term view, because we may dip below 1,000 and we may sit there for a little while, but very optimistic about the long-term potential there. So I've definitely taken some losses though. There's some tax advantages to it, but we're gonna keep building.
Bobby, Supercycle, did you buy it for even a fraction of a second?
So yeah, I mean, if you take a long-term view, if you think of crypto in the next 10 years, then I think we are kind of on track, right? I mean, it's a super cycle, it's going up, it's going down. I mean, it will go back up again, but I mean, obviously there will be a correction, and this correction that we're seeing right now is what I anticipated, but eventually it will go back up again and then breaching its all-time high. So yeah, I think super cycle is kind of in play, but like with all these volatile bear markets that we see. So yeah,
so it's basically it's basically NASDAQ 2001, and then we'll see you in 2015 when it's like, actually Jeff Bezos was the genius. No, but that wasn't really the super cycle. The super cycle was this time it's different. That was the meme.
Nah.
And
I mean,
this time it's
there's
not
always a
this time-
correction. There's always going to be a correction. Always going to be a correction.
I will honestly say I never bought it. I looked at it and went, no. Like, I would rather be on the side where it's never different. The market cycle is the market cycle. To escape the market cycle, something fundamentally has to change in human nature. And that's never going to happen. So I fully expected the super cycle to be a dud. And so it has proven. But long-term view on all of this, I'm net positive because I think having been through 2018, 2019 and seen what death looks like and what crypto winter looks like and come out the other side of it with all these other things going, I'm like, okay, fine. The only debt I have now is time. And I'm good with that. So, whatever. Well, listen, I think this is a very apt time to call it quits here. I was looking through the chat and seeing if there was any interesting comments. Someone was talking about, for you, Bobby, whether you were going to list the correct... There we go. Here's a comment. Are you going to list the correct information for Pulse, PulseX, and all the PRC20s? Or are you going to deny people that info like you do with Hex? Answer, Bobby. Why haven't you listed any... I mean, you can say no comment, and I won't hold it against you.
No, I mean, I don't know what Pulse is, actually. So...
there you go.
And then, yeah, I've never heard of it before. And we have criteria, our team. I mean, read through our methodology. It's very clearly, we don't disclose the exact method which we use, whether to allow or not allow. We have internal check to check whether the market cap makes sense or don't make sense. And then if it makes sense, we add them onto for all the tokens. So if you want a market cap, like go through and do it. Some obvious ones, we don't list them. I mean, it just does not make any sense to us. So we just don't want to list the market cap.
Fair enough. C squared, any thoughts on where Index Coop goes next? Anything that you can give us for like just your product and specifically, and how you're going to grow and develop through what might be some painful years ahead?
Yeah, I think one of the top priorities for us in terms of products that we'll be launching will be really standing up like safe haven assets. So, in traditional finance, if we're oversimplifying things, whenever the picture for equities looks really grim, you'll have a big transition towards fixed income, bonds, interest bearing, low risk assets, and we don't really have great options for that in DeFi. Granted, there's a lot of money market protocols and some other interesting like lending opportunities, but that's really what we want to create. We want to create the tools that people need to survive the markets, regardless of whether it's a bull or a bear. So that's really what we're building right now. Should see a couple really exciting, lower risk, stable coin and ETH denominated yield products coming out over the next few months, so that people can survive the bear market and then also position themselves well for the next bull.
And it's worth definitely saying that Index Coop is building indexes, and indexes are traditionally the most conservative investment vehicles that you can kind of invest in. But you're doing it permissionlessly on chain. You can invest as little or as much as you want, and that is really, it's democratic, and that's I think what DeFi should be all about. And so I salute you for continuing to build what I think is probably going to be the killer product for DeFi over the long run. So hats off to you. My thanks to Bobby Ong, C squared from Index Coop. Thank you so much for joining us on what has been a truly spectacular week, as if we didn't need enough of those. But thank you so much. And do go and get your information from CoinGecko, and do go and check out Index Coop, because I think you'll be surprised at what DeFi can actually do for you. This was the Defiant, and before we end, we must turn to the sponsors. But if you have any final words, Bobby or C squared, now is your time. They have nothing. Look at that. Thanks, guys. I'll see you on the next one. Thanks, everyone, for joining. And if you're on replay, don't forget to subscribe, like, and comment, and do all that stuff. We appreciate it. Peace out. Have a good one.
Zeta Chain is the first public Layer 1 blockchain that natively connects with any chain and layer without wrapping or bridging assets. This unlocks a new class of omni-chain dApps, such as smart contract managed external assets, even on Bitcoin and Dogecoin, multi-chain NFT ownership, cross-chain DeFi apps, and much more. Check out their developer docs at zetachain.com and start building the future of multi-chain.